Thank you guys for joining. And as you saw from the previous screen, if you want to follow us on Instagram, that is great. And also our podcast is available. So first, a couple of housekeeping items. So number one, my name is Mark Lamonica. I look after the individual investor team in Sydney for Morningstar. But all our compliance checklists. So number one, anything you hear today is general advice. I don't know anything about you, so I can't offer you personal advice. If you are over in New Zealand and you want a copy of our FAP, go to our website, morningstar.com.au. And also the New Zealand regulatory authorities would encourage you to get a financial advisor if you would like personal advice. All right, so today we're talking about funds, ETFs. We're going to throw in some licks in there too. We're going to talk about the decision-making criteria that you can go through to find what is right for you. I would love questions. So anytime you want a question, there's a Q&A, there's a chat function. Anyone who's on Instagram or Facebook watching this on one of the live streams, send in a question. It'll go to Will. He'll send it to me. It'll be very exciting, and we'll answer those as well. All right, so we're going to talk about funds, ETFs, and LICs, and we're going to talk about the different decisions you need to make. Number one, which one potentially is right for you, if you are going to take an active or passive approach, and just help you look at some of the different characteristics of them to find the investment that is going to help you achieve your goals. So for those of you who attended the webinar that we had on Thursday, we walked through three of the four-step process of trying to design a portfolio that will help you achieve your goal. So as a reminder, first step we walked through is define your goal, and we got very specific about that. How much money do you need to achieve your goal? When do you need it? How much can you save over that time? And of course, how much money you have now. We did all that because those are the inputs that go into a formula to calculate your required rate of return. Once again, your required rate of return is simply the return that you need to get from where you are to where you want to be. And the reason we did this is because that will help you decide on the asset allocation mix that you need to help you achieve your goals. So once again, we think that you should take a risk capacity approach to designing a portfolio. That means what is the risk you need to take to achieve your goals, rather than a risk tolerance approach, which just says, what do you feel comfortable with? Well, if you are comfortable with not achieving your goal, then go do the risk tolerance questionnaire. We think risk capacity works much better. So once you've done this, and once you've selected an asset allocation target for your portfolio, then of course we get into picking investments. And one important thing to add here, and I know I say this a lot, but at Morningstar, we are about the investor and not the investments. That's why you're picking investments last, because the most important thing is you achieving your goal, not copying what your mate tells you at a barbecue about what to buy. So we're going to start with you. That's what we started with last time. And now, finally, on the last stage, once we've gone through all those steps, we're going to talk about the actual investments. All right. And picking investments is really fun when the market just goes up. It's not as much fun when the market goes down. So that's why we want you to focus on you. All right, so let's talk about a couple different things. And one thing that I think is important just at the top of this slide is there is no right answer in this process. There isn't right answer for you, however. So that is what you're trying to achieve. It's your temperament and what you're comfortable with and what will ensure that you can stick with this for the long term to achieve your goals. So let's talk about instruments. So we talked about this a little bit before. So that's when we're looking at what actually goes into any of these investments, shares or bonds or any other different assets. So it is very important. I'm seeing more and more people talk about ETFs in particular, like they are some sort of investment. Well, no, they're just a vehicle that holds underlying investments, which are going to dictate your return. So the shares, the bonds, whatever other asset class, and remember we walked through the strategic asset allocation that Morningstar provides to premium subscribers, whatever asset class you are trying to allocate your portfolio to, that is your required rate of return, and the decision-making criteria that you need to make is the required rate of return to help you achieve your goals. So we're going to talk today about strategy and vehicle. So we'll talk about active versus passive. And the decisions you're going to make on active versus passive are probably going to be influenced by the characteristic of the asset class. And we'll walk through what that is. So many people, I think, believe that they need to take an all active or an all passive strategy. So I think that's certainly being encouraged by certain people in the industry. But remember, depending upon the asset class you're trying to get exposure to, you may pick a different approach. Then we're going to talk about the vehicle. So we'll talk about ETFs, funds, and LICs. And this really has to do with your personal circumstances. So once again, I think that a lot of the discussion around the industry, probably particularly around ETFs, is influenced by a lot of marketing and the ease with which you can buy ETFs. But there could be circumstances where that does not make sense. All right. And thank you. We've got one question. I'll get to the question in a second. And keep them coming. All right, let's do a very brief overview of these three different investment vehicles. All right, so let's start with exchange traded funds. So once again, when we look at certainly ETFs and funds, we'll get into LICs, they're a little bit unique. Something that's important to remember is, one, they can all hold all sorts of different assets in them, right? They are just a container that has a bunch of assets in them. They can all be active versus passive. So another misnomer we hear a lot is that all ETFs are passive. That is not true. And a lot of people think that all funds are active. That also is not true. So in both cases, which we'll get to on the next slide, in both cases, you can have active versus passive strategies in them. So what is an exchange traded fund? Exchange traded funds is exactly what it says it is. And we'll get into some specifics in a second, but it is traded on an exchange. So what does that mean? That means that you can buy it through your broker. So any online broker will allow you to access an ETF. Makes it very easy to trade. Now, trading is not necessarily a good thing. So we'll talk a little bit about the downside of that, but people do like them because they're easy to access. So that's an ETF. Very briefly, what is a fund? So managed funds in Australia, anyone who follows anything in the US, it's a mutual fund. They're basically the exact same thing. Obviously, the legal structures are a little bit different based on countries, but they're the same thing. So what is this? It is an investment where they are pooling your funds with other investors, and there is a professional manager that can be either an active or a passive, take an active or passive approach that's going to invest your money. Finally, LICs. And LICs are a little bit different. So a LIC, once again, trades on a stock exchange. So a listed investment company trades on a stock exchange. So the listed there tells you about that. It is incorporated as a company. We'll get to some of the nuances of what that means. Once again, it's professionally managed. Now, LICs are all pretty much active, or I'd just say they're all actively managed. That means somebody is making active decisions on what goes into those portfolios. So a manager, or I can't think of any offhand in Australia, but also it could be an algorithm. It could be a computer that does this. But somebody's making an active decision on what to buy or sell versus passive, where we're following an index. So they can have any sorts of different asset classes in there. Now, they trade on an exchange, which makes it easy for you to buy and sell once again. But unlike an ETF, they are close-ended. So in the US, these are actually called close-ended funds. So what does that mean? It means that there could be variances with a LIC, and some large variances between the value of the assets that are in that LIC and what it's actually trading for. Because what's going to determine the price that a LIC trades for is supply and demand. So much like a share, if there are a lot of buyers and very few sellers, what happens? The price goes up. If there are a lot of sellers and not as many buyers, the price goes down. So there can be, because of that, because of investor demand, there can be large variances between what the assets are worth, what the LIC is actually trading for. We're going to talk about this a little bit more, but that is not something that you confront with funds. Funds will always trade for what the assets are. This is something that you minimally run into with ETFs. There can be small differences, small premiums and discounts, but generally, and we'll talk about how this works, generally there is not a large difference because of some mechanisms that have been put in place to keep that ETF trading close to the value of the assets in it. All right, so that's a brief overview. We will get into some more specifics. But first, let's talk about active versus passive, because this is the first decision that investors need to make. And the very brief history of active versus passive is at one point, all investment vehicles were actively managed. So we're talking back, I believe the first index fund was in the late 70s. All investment vehicles were actively managed, meaning there was a manager. The manager was making investment decisions. The, of course, downside for you as an investor was that you were paying the manager to make those active decisions. So people that work in portfolio management make a lot of money, and you, of course, are spending that money. And also, of course, the fund companies made a lot of money off of these funds, and you were paying for that too. And it wasn't actually Bogle that did this, John Bogle from Vanguard, I believe. I think it might have been Merrill Lynch or Bank of America that had the first index fund, but Vanguard popularized them. And Vanguard certainly created, they popularized them. They are one of the largest asset managers in the world now because of the attractiveness of passive. And Bogle went out there, and he was the CEO of the company, and talked about basically the fact that a lot of the active managers, especially when you took fees into account, were not actually beating any of their benchmarks. So why pay a high fee for inferior performance? Why not pay a low fee to Vanguard and other index providers that have sprung up to just replicate the index? So not the theory, the fact behind this is the index represents the average return an investor will get. Now, once you remove fees, that means the average investor will get a return that's below the index. And we'll talk about some of the implications of what's happened with passive later, but passive has become very, very popular, especially since the GFC. There's been an acceleration in the number of passive investors. Now, as people have probably heard that I've talked about on these things before, there's kind of been, and whether this is the cause or the effect, there's been a reason for that. Markets have done very, very well since the GFC. And specifically, what has done very well is large cap growth shares, which drive many of the indexes, because the indexes are market cap weighted, meaning the bigger the company, the more they make up of the index. So when big companies are doing well, indexes will do well. Versus if you took a look at the average company's performance in an index, we've seen outperformance by the index over the average company. Now, that has not always been the case in history, but that has happened since the GFC for the most part, and that could have driven a lot of the popularity of indexes. And also index investing and passive investing could have been one of the reasons this has happened as well, obviously, because more investor dollars that go into that index are going to push the largest components of that index up. And just remember, the same thing will happen on the downside. All right. Active investing, passive investing. As I said before, depending upon the asset class you're trying to access, there may be one that is beneficial. So let's talk through some of the different implications of this and some of the different categories and the ways that we want to judge if a certain asset class is better to be actively managed or passively managed. All right, so let's talk about the efficiency of the market. So the efficiency of the market refers to security prices reflecting value. Now, efficiency of the market is very difficult to judge, of course, because we don't actually know the true value of any asset. We are estimating, and when we go through the how to value a share portion of this, we talk about how we are estimating the value of a share in that case. We're doing that by creating estimates of future cash flows, and we're discounting them back to the present. Those are, of course, estimates. None of us know what's going to happen in the future. But an efficient market is a market where security prices and values are very close together. So much so that this efficient market hypothesis, which we've talked about before on these webinar series, says that the market is always perfectly priced. Now, we don't believe that here at Morningstar. We, of course, our equity research team believes that there can be periods of time where there can be sizable anomalies between the value and the price of an individual security. But a very efficient market, those gaps would not be as big. Now, if a market is more efficient, then that means it is harder for an active manager to go out there and beat the index, because those anomalies do not happen as much and they're not as wide between the value and the price of an asset. So in more efficient markets, if it's harder for an active manager to beat that market, then passive is most likely a better approach. But if there are big anomalies, then we can look at active. Now, how do we judge this? Well, we judge this at Morningstar by a report that we do called the Active Passive Barometer Report. And basically what we do is we go back over a long time period, so 10-year period. We put this report out every 6 months, but we look back 10 years and we look at what percentage of asset managers or of active managers were able to beat their index in each asset class. What this tells us is that if a very low percentage of active managers were able to beat the index, that is a more efficient market. If a larger percentage were able to beat the index, it's a less efficient market. And in those less efficient markets, active management might be a better opportunity. We'll go through some of the reasons why that may be, but let's move on. Fee hurdle. All right, so obviously, in most cases, active management, as I told you, you have to pay for this investment team. You're paying higher fees. So, of course, you need to overcome that fee hurdle in order to have active management add value for you as an investor. How representative is the index? All right. So representation of the index looks at the total universe of investable securities in a certain asset class versus what is in the actual index. So, for instance, if we look at large cap US stocks, the index that we are tracking there is the S&P 500. So the 500 largest stocks trading in the US. So that index is very representative of the investable universe, right? Because it basically makes up the whole thing. We go and we look at fixed interest for a while. So we're talking bonds now. There are a ton of bonds out there. There are a ton of bonds out there because even the same issuers continually issue new bonds, right? So they are having very frequent, if you're the US government and you're trying to fund your operations, you have very frequent issuance of bonds. So in fixed interest, for example, the index is less representative of the universe of bonds that are out there. And so the theory behind this is that if the manager has a larger group of securities to play in that is not represented by the index, it gives him or her a better opportunity to outperform that index. So that is the representative of the index. The other factor we want to look at is how liquid are the underlying assets. So liquidity just refers to how much a security trades. And the implication is that if you are an investor trying to buy the security, it is, of course, easier for you to buy and sell. And by easier means that you have to pay less in a buy-sell spread if something's really, really liquid. And why this matters for passive management is passive managers have to replicate an index. So if there are index changes with illiquid assets, it is more expensive. It's expensive in terms of literally what they're paying for trading between these buy-sell spreads and how much the security price is going to move, or they're trying to buy it or sell it. It's harder for passive managers to operate in these markets. So that could increase things like tracking error, for example. So differences between the index performance and the ETF or fund that's tracking it. So active management can be an advantage in these markets that don't have a lot of liquidity, because an active manager doesn't have to follow an index. An active manager can slowly build a position over years if they want, and only trade when it actually is advantageous for them to do so, rather than needing to keep up with that index. So these are some of the factors that you need to go into. If anyone wants a copy of this active passive barometer report, just send me an email, mark.lamonica1@morningstar.com. It'll literally walk through all of these different asset classes and look at where active managers have outperformed their passive counterparts. And if you are a premium subscriber and you go on to any of our fund and ETF reports, they will often, our manager research team will often write about this. So we're recording a podcast after this and we're talking about infrastructure. So infrastructure and listed property. So, an example that I was looking through last night is listed property. So think REITs, so real estate investment trusts. Our manager research team believes that if you're investing in Australian REITs, that you should use a passive vehicle because there are not a lot of them. So that the index isn't very big, and they think the best approach is passive because there isn't that much of an opportunity for a manager to outperform. However, they think if you're investing in global REITs, so global listed property, that active management has its merits. So you can read about these in our fund and ETF research reports just to understand per asset class what our viewpoint is. All right. The other thing that's really important to consider is not just active or passive. So you make that decision based on an asset class. Then you have to decide what is the vehicle that you want to use in order to access this. So once again, LICs are active, but ETFs and funds in most cases, for each asset class, you can find an active or passive option between the two. So you need to decide how are you going to actually access this. Now, ETFs have become increasingly popular around the world and here in Australia, where growth has actually accelerated past growth in the rest of the world in terms of popularity of ETFs. And one of the reasons in Australia, and as an American that moved here, albeit a while ago, I was very surprised at how difficult it is to access funds. So funds traditionally have been distributed through advisors. There are platforms that you can go on as a individual investor, and you can literally invest directly with the fund. All of it is a huge pain. Whereas in the US, you buy all your funds through a broker. So they still obviously don't trade on exchanges, but you can access them all through your broker, which makes it a lot easier. But funds do have, and they're not as popular with individual investors, but funds can play a role in your portfolio depending upon your personal circumstances. So let's go through and talk about some of the characteristics, and we'll talk about why you may want to use one vehicle or the other. And we're comparing these, of course, just to equities, just so you can get an idea, because a lot of people intuitively know how to trade stocks. All right, so transaction costs. So transaction costs, there are two parts of transaction costs that people generally don't think about. The first, of course, is if you are making a trade through your broker, you have the brokerage that you're paying, and it varies widely. We have a lot of very discount brokers. We have some free brokers now. So this is pretty specific to how you access the market, but generally you'll have to pay a transaction fee, but you also, of course, pay the buy-sell spread. So the buy-sell spread is the difference between what a buyer pays for something and what a seller pays for something at any given point in time. And that is driven mainly by liquidity, right? How much the security is traded. So you pay them for equities, you pay them for funds, you pay no transaction costs for a fund. So there's no actual brokerage on there. ETFs, you're paying both, just like equities, brokerage, buy-sell spread, same thing for LICs, right? Because these three, equities, ETFs, and LICs, all trade on an exchange. Funds do not. Management fee. So obviously there's no management fee if you just go out and buy a share. Generally, the management fees. Now, these are big generalizations here. So go look at any two. If you're considering a different investment, go look at them specifically. Generally, you'll pay more for a fund, and we'll get into why in a second. But basically, there is a lot more around the way you transact with funds that you'll pay for in those fees. Generally, ETFs are slightly less and LICs are more. Now, these are generalizations. You have to look at the individual security that you want to buy, and remember that fees are very, very important. Valuation method. So there's no valuation method for equities, right? Our analysts value them, but there are a lot of different opinions out there on what something is worth. For funds, so funds will always be traded. You'll always transact in a fund at the net asset value. So that is the total of all the securities that are in that fund. So the way a fund works is it could be global, but traditionally, if you're investing in a fund that's trading Aussie equities, we wait till the end of the trading day. There's a fund accounting team. They go in there, they price every single position in that fund, and they strike a NAV. So they'll strike this net asset value, and the net asset value basically says how much a unit in that fund is worth. And that is the price that everyone transacts at. So if you want to buy or sell a fund, and they call them subscriptions and redemptions. You want to subscribe to a fund, you would say, okay, I want to invest $1,000 in your fund. Let's say you decide that at 10 a.m. You communicate with your fund company or your platform saying, I want to subscribe, I want to put $1,000 in. Somebody else might say they want to transact, they want to have a redemption, they want to take $1,000 out. You wait till the end of the day. At the end of the day, they will value all those assets and they'll tell you the price that you're transacting at. So as a fund investor, you don't actually know the price that you are going to transact a fund at. You'll know the price the day before, but anything could happen in the market during that day. Then you'll find out at the end. So that's one of the reasons that people don't like funds. I think that criticism is probably irrelevant for most investors in most situations, but that's the way a fund works. But it does mean that you will always transact at that net asset value. ETFs. So there's a mechanism that's been put in place for ETFs to trade like a share. So trade on an exchange where supply and demand will have an influence on them. But there's been a mechanism that's been put in place to make sure that ETF does not get too far away from the net asset value. I won't spend too much time on it, but basically what it is they just create more units. So there's something called an authorized participant, which is generally an investment bank or market maker, same thing, whatever you want to call it. And if there is a deviation between the net asset value of the assets and the price of the ETF, they can step in and either create more units or remove units from the ETF. So basically, if there's too much demand and the price of the ETF is getting higher than the net asset value, all of a sudden what they can do is they can exchange, they can remove units by basically taking them out of circulation and then selling off all the constituent parts in it. So obviously they're doing all of this with computers very quickly. And that is an arbitrage opportunity for them because it's a riskless profit. So instead of an ETF, they buy the ETF, they break it apart. The ETF has 10 different shares in it. They break it apart and they sell those 10 shares. So that is how they are managing to keep that NAV close to the price it's trading at. Now, there are times during the day, particularly in the morning, where there can be larger deviations, but it does not get that big in general. Now, if the assets are less liquid, if there's less liquidity in the ETF, it could get a little bit bigger, but generally they keep very close. LICs do not have that mechanism. So supply and demand drive LIC prices. So you can have large premiums or discounts in a LIC. So what does this mean? It means trading flexibility, as we're going through all of this, is really high for anything on an exchange and pretty low for funds. Now, you need to think about trading flexibility in terms of how important that is to you. So many times, I always use the analogy that if you're trying to lose weight, you probably shouldn't fill your entire freezer with ice cream. Same thing. Trading is bad. So countless studies have shown that overtrading leads to bad investor outcomes. So it is a little less tempting to trade a fund because there are speed bumps in the way of you actually transacting. So think about how important that liquidity is. Like, I know that people think that this is really important. Like, they need to sell all their ETFs and load up, I don't know what, their car and escape some sort of disaster with all their money. But just think about how much that is actually worth to you. And is it worth the fact that you could make poor investment decisions because you have that ability to trade. Minimum investment. So one of the problems with funds is generally it's a lot higher. Now, for ETFs and LICs, yeah, you can trade a share, but you probably shouldn't, or trade a unit, but you probably shouldn't. This all has to do with the transaction cost. So this is really what you need to look at with LICs and ETFs. If you are just starting out, and ETFs are very popular with newer investors. If you're just starting out and you're not investing that much money, just realize those transaction costs can eat up more and more and more of your investment, particularly if you're going kind of paycheck to paycheck, trying to invest every paycheck. Now, there are platforms that remove this. They all do charge pretty high admin fees, like shockingly high admin fees for some of the investors they have. So I'm talking about like Raise, for example. But remember, transaction costs in ETFs and LICs make them less attractive for sort of continual dollar cost average investing if you're investing small amounts, because of course you have to overcome those transaction costs before you start making a profit. So the very simple example, which is unrealistic, but if I am investing $100 and I'm buying $100 of ETFs every single time that I get my paycheck, so for me at least that's twice a month, and I'm paying $10 brokerage fees. So what does that mean? This is obviously an extreme example, but it means that I need that ETF to go up 10% before I make a penny of profit. So think about that. Think about what those implications are. That is something that is probably unappreciated about funds. So with a lot of funds, whether you are using a platform or whether you're going directly to the fund company, you can set up investing plans where you can invest small amounts of money without paying any transaction fees. And oftentimes, if you set up one of these savings plans, the minimum will come down. So all of a sudden, you don't have to invest as much from a minimum standpoint, which funds do have. And it means you just have to commit to saving a certain amount in the future, but then you're not paying any transaction fees. So think about that. So we kind of hit this point already, but behavioral risk, which basically just means the risk that you'll do something stupid, which is overtrading, which is putting in a bunch of money at the top of the market, which is selling at the bottom of the market. The risk that you'll do something stupid is generally higher on equities, ETFs, and LICs. Things that you can trade, generally it's higher. This is something to think about. But anyway, thank you guys for joining. And you can see Shawnee's arriving in the back to record our next webinar. But anyway, thank you guys.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.